Well, hey everyone. Happy Thursday, July 31st, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming through from an absolutely beautiful Redmond, Washington. We haven't had rain in a long time for us Seattleites. That's a bit of an issue because we've come to rely on the rain. So my kids get all squirrely when it's all sunny days like this. Tells you how messed up your brain can get when you live in certain places for a period of time. But overall, I would say a joyful time to be in this region with some lovely weather, some beautiful sun, cool temperatures, big air show coming up this weekend. Life is pretty good. Hope you guys are doing well and hanging in there wherever you're tuning in from. I appreciate you guys tuning in live. We're live streaming on Facebook, LinkedIn, YouTube, and X. And you are welcome, if you are tuning in live, to ask questions all along the way. You can enter a question in any place where you can add comments on any of those live stream platforms. I can see that live as we go, and we'll grab a question or two at the end of the episode. Appreciate you guys asking questions as we go. Really makes the show entertaining, gives us some different content to throw around. Also, if you're watching the replay on our YouTube channel, drop a comment or drop a question in the comment section, and we'll do an all mailbag episode on Friday. And could get to your question. Randomly, a lot of charts that I will show the next day comes from some question I got on the YouTube comment section from the previous day's session. So it does help me to kind of shape the content and get to things that you guys are interested in. So keep the great questions coming. That's a decent enough intro. Shall we get to the charts? You know, today we're going to talk about the markets. I mean, not a great day, right, for equities. I mean, it wasn't a horrible day. And again, it's been so long since I had really rough pullback kind of days. But I tell you what, this is starting to feel more and more like what I would expect the market to feel like going into August and September after an incredible spring and pretty decent uptrend through the summer. This is sort of the classic seasonal playbook, would be strength in the summer. And certainly since COVID, very strong in the summer, particularly June and July. And then August and September tend to be relatively weak. Now, I'm not a big fan on selling just because we flipped the calendar to August 1st. That, in my opinion, is not the best investment strategy ever. But looking for signs of deterioration because we're at the time of year when it often happens, I think is just part of being a well-informed, diligent gatherer of evidence in your investment process. So for what it's worth, days like today seem fairly reasonable given the run that we've had. Let's talk about what sort of damage was done today and reflect on the fact that overall trends are pretty good, although leadership rotation seems to be happening here, as you'll see with some of the charts we'll share. S&P 500 ended the day down about 0.4%. It closed just below 6340. The market opened and was briefly above 6400 before rotating lower through the course of the day. No late stage rally today. The last hour was actually relatively weak and cemented a down day for the major averages. The NASDAQ composite ended up flat, although it was higher earlier in the day. The Dow down about 0.7%. Mid caps, small caps, both down just over 1%. The VIX moving higher by about 1.25 VIX points. So we're still kind of in a low volatility environment below 20. We are just above 16, which someone had thrown around recently as one of their, one of their kind of, very low volatility versus kind of low volatility measures. For me, it's anything below 20 is pretty much noise. Anything above 20 is when investors are getting nervous. I had an interview earlier today, by the way, with John and Jack Kosar. John Kosar, I've interviewed a number of times. He's a fellow CMT. He runs a firm called Asbury Research in the Chicago area, which he's run for decades. Fantastic technical analyst who I've appreciated talking to many, many times. He and his son really have a model-driven approach based on technical analysis, a bunch of different indicators. And I asked him toward the end of the interview, like, what's that warning sign you would be looking for right now going into August that would tell you, this is something we should really be concerned about? He said a spike in volatility, right? That was the one thing out of all the things he could have shared. That's what he kind of went with. And I like that answer because, the VIX doesn't spike if people are still kind of calmly accumulating shares and feeling pretty confident in this uptrend. A spike in volatility means a spike in uncertainty. It means a spike in fear. Most likely results in a drop in equity prices. We'll have that podcast interview for you probably tomorrow. My interview with Callum Thomas, a couple of people asked you about it because I mentioned it earlier this week. It's on my list of things to do today. I just haven't gotten into it yet, but I will get to it hopefully before the end of the day here and publish it for you. So keep an eye on that. Callum Thomas runs top-down charts. He's a strategist based out of New Zealand with some really interesting thoughts. I love talking to someone who is based very far from where I am, just because their life experience, their professional experience can be completely different, and I think that's pretty valuable. All right, summary of the first point here. Stocks were down today. Let's dig a little bit into some of the other asset classes and see what happened. Rates generally drifting lower. We have the 10-year yield just below 4.4%. Long bond yield finished below 4.9%. 5-year points still kind of languishing below 5%. So, I mean, not a huge change in rates, but, rates kind of coming down slightly. Bond prices, the dollar, really not much of a change. This wasn't a big movement day in fixed income generally, or in the dollar. It was really more equities and cryptocurrencies, as you'll see in a minute. Further deterioration in copper prices as we get to the commodity section. Crude oil prices were down as well. Gold actually slightly higher, about 0.2% up. The GLD is holding support around $300. Silver down about 0.6%. That's using the SLV. You can see kind of mixed results in the commodity space today. Crypto's all down, right? Yesterday they rolled over. Today they roll over again. Bitcoin did briefly get almost to 119,000 earlier today, but rolled over during the equity trading session, basically in a free fall as stocks were kind of retreating. Bitcoin currently down just over 1%, currently around 116,600. Ether prices just about 37.40. All right, looking at the 11 S&P sectors, we have communication services, utilities, and industrials barely up on the day. So those are your only three sectors that actually finished in the green, and industrials were basically flat. I'm talking a penny difference from yesterday. So we'll call it two sectors that actually gained anything today. Communication services, and that's coming off of Meta's pretty strong earnings win, propelling that sector higher. Utilities, the XLU up 0.5%. Industrials flat. Everything else was down today. Healthcare, kind of a big deal, going down significantly today. As we get to the market carpet, you'll see there's a lot of red in the healthcare sector, down almost 3% today. REITs down 1.8%. Materials down 1.3%. None of this looking yet like it's going to make our short-term model turn negative. Our market trend model is a proprietary model that it's not that secret. I share the details behind it in a lot of places. So proprietary just means I kind of developed it, but I'm pretty open with what's involved with it. It uses weekly S&P data and uses exponential moving averages to just calculate a quick check on the trend on 3 different time frames. And in this sort of environment where the market trend model is bullish on all time frames, you look for the short-term model to turn bearish. That would be an initial sign that we're in at least a pullback phase. The medium-term model turns negative. That's more of a correction. The long-term model turns negative. That is a secular bear market kind of feel. At this point, still bullish across the board. So let's keep things into proper context. We haven't even pulled back enough for my short-term model to suggest this is a pullback yet. But that's what we'll continue to watch for. And again, we'll keep our premium members at Market Misbehavior updated with any change in that market trend model as we like to do. Breadth not great. I feel like I've said breadth not great in some form all week here, and continuing today. On the New York Composite Index, 60% decliners to 38% advancers. On the S&P, even worse, 72% decliners. In the small cap index, 77% decliners. So this was very much a distribution day, any way you slice it, right? With more stocks down than up, more sectors down than up. Some random Meta kind of eBay kind of names having some double-digit gains today, which is awesome, but the average move was not good. Let's look at the Magnificent Seven and see how things played out here. Meta, of course, with a strong earnings win yesterday, closed up over 11%. Microsoft up 4%. It was up a lot more earlier in the day, as you'll see from the chart. Closed near the lows of the day. So it was sort of a gap higher that appears to have been sold pretty aggressively compared to Meta, which seemed to maintain its gap higher. Amazon, of course, reporting after the close today. We'll check on the after hours trading here in a few moments, but closed 1.7% higher. Tesla testing the lower end of that range. We've talked about sort of the coil patterns, kind of the consolidation pattern in Tesla, currently down about 3.4%. Broadcom one of those leading technology names down 3%, Alphabet down over 2%, Netflix down over 2% as well. We'll talk about it in a minute, but I mean, one of the things that I'm noting, I mean, every day this week, the market, the S&P 500 closing below the open, closing more closer to the lows of the day than the highs of the day, generally, particularly in the last couple of days. Not great. I mean, it's not giving me a great feel. That's more of a spidey sense kind of thing. That's not the way I like to, run a portfolio, but it is something I've learned to listen to. All right, let's get into the heat map here. As a reminder, I do see plenty of great questions coming in on YouTube, on X, on Facebook, on LinkedIn. Please keep the questions coming during the live stream. We'll grab a question or two at the end. And questions we don't get to, we will put in the mailbag. We're planning an all mailbag episode tomorrow on Friday, which will be the first trading day in August, by the way. So get your questions in now, and hopefully we can hand select it for a deeper dive on tomorrow's mailbag episode. I mean, heat map, not great, right? I mean, this doesn't look particularly good, and it shows how Meta and Microsoft, with their earnings beats and their strong moves today, are really the outlier, right? After yesterday's close, when I saw, during the show, we're talking about Microsoft and Meta, talking about earnings, we're looking in the after hours, they're gapping higher. I mean, everything, Microsoft, all about cloud, expanding, their cloud services going well. Meta with just great, results and high expectations. So it feels like this should be just a resilient update for stocks. Not to be. And the fact that the market's not up more than that after Meta and Microsoft beat start to imply that weaker breadth conditions could really start to weigh on this market, right? I always have said if the Magnificent Seven stocks are strong and everything else is weak, the market can still go higher. A day like today, I think, reinforces the fact that the strength in the S&P and the strength in the NASDAQ 100 almost deceiving at this point, right? The market is not those seven stocks that make up a ton of the weight in the S&P and the NASDAQ. In some ways, it certainly feels like it is, and they certainly have an outsized weight. But the average stock appearing to struggle here a little bit, to a lot. So the major averages almost look deceivingly strong, given the weakness that we're seeing elsewhere. Just within technology, right? Look in the upper left corner of the heat map. You can see besides Microsoft up, you can see things like F5, Tyler Tech, TYL. Seagate, STX, Western Dig, those are the two hardware makers. Those are up, hard drive manufacturers, those are up pretty good. But then after that, it's a lot of stocks down quite a bit today, right? ServiceNow down 3.5%, KLAC down 5%, Palo Alto down 5%, Workday, Texas Instruments, Qualcomm, IBM, Lam Research, Micron. These are all stocks that are down 2-3+% today. So, again, even in one of the charts I grabbed just to sort of drive this day home was the equal weighted technology ETF. We'll take a look at that. You'll see that it doesn't look nearly as strong as the cap weighted technology ETF or the NASDAQ 100, which is, of course, dominated by the Meta and Microsoft kind of charts. You look at more of the, the general trend in the average stock, and it's not nearly as good. So a lot of red in technology, I think, is concerning, right? Because that shows you all of a sudden this is a narrow group of growth names that are still doing quite well. A bunch of growth stocks are actually starting to sell off pretty good after an incredible run. Same can be said for consumer, top middle. You have Amazon up 2%, Tesla down pretty significantly, but the average consumer name struggled. Same in healthcare. Healthcare was, pretty much a train wreck of a day today, right? Eli Lilly, Merck, UNH down over 6%. So a lot of weakness in the healthcare sector. We talked about that resurgence in healthcare as potential emerging strength. Boy, not on a day like today, though. This is making those charts look a lot less ideal. The financial sector at times has looked remarkably strong, but giving back some of those gains here as of late. So with all of those things that seem to not be looking so good, what is looking good? Obviously, a handful of big growth names still looking quite well. And it shows you how the AI trade, the cloud trade, the Meta Microsoft trade is pretty much saving this market from looking, ridiculously negative. I mean, you wonder what today would look like if Meta and Microsoft were both down about 2%. I feel like the major averages would be bright red today. just because of those weight. I mean, those gains are single-handedly kind of keeping this market looking a lot better than it would otherwise today. So what else looks good? Utilities, right? Defensive sector, a lot in the green there. Industrials, while there are some mixed results, charts like Howmet coming down, the average chart in industrials probably better than the average chart in some of the other sectors as well. Some random staples like Costco and Philip Morris, but I mean, other than that, I mean, not a great look today, right? And I think that's going to be the issue. One day doesn't make a trend. One day does not make a change in trend. But days like this that happen consistently really can weigh on the markets pretty aggressively. All right, shall we go to some charts before we get to the charts and talk about some takeaways? I do want to let you know, by the way, one of our longtime partners on Market Misbehavior, Koyfin. Koyfin is a platform really designed for investors that want deeper fundamental data, deeper economic data, deeper international stock coverages. There are a lot of great charting platforms out there. Koyfin has good charts and great everything else. It really is designed as a low-cost alternative to something like a Bloomberg terminal, which I had for many, many years. And when I launched my own firm and started writing a check to Bloomberg once a quarter, I very quickly started to question that investment because it's a lot of money. Something like Koyfin is a distant low cost relative to something like a Bloomberg or a Fax or one of those institutional platforms, but it's trying to give institutional capabilities to individual investors, also financial advisors. And a lot of the great improvements they've made to their product are really optimized for advisors. So if you're in the advisor community, you're working with clients, Koyfin allows you to create some really cool reports, ways to enhance a conversation with your clients, and I encourage you to check them out. You can find more info at marketmisbehavior.com/Koyfin, or just scan the QR code that you see on your screen. Make sure you use my link. You'll get a better deal than if you just go to the website, and it helps me make Market Misbehavior awesome. So go to marketmisbehavior.com/Koyfin for more info on a product that I still use every trading day. All right, continuing on here, shall we look at some charts? Not a great candle here today, right? Big outside day. We've had a couple outside days, but this is the most outside of the outside days that we've seen. It's almost an outside week of sorts here. So we had a higher open, right? At the open, we made a new all-time high on the S&P 500. So the first half an hour of trading, we are gaining, we are pushing above 6,400 for the first time. But from there is a bit of a free fall going into the close. End of the day, higher high today, lower low, and with the down close, that is another confirmed outside day. So these outside days, 2 of the last 4 sessions have been outside days. That's when from one day to the next, you have a wider range and a deeper close. And bar chart analysis would tell you that's not good. That tells you that's distribution. It's kind of the bar chart version of things like a bearish engulfing pattern or a shooting star candle or a dark cloud cover candle, any of those kind of reversal patterns that suggest short-term reversals in sentiment. The bar chart analysis is giving you that sort of thing. These are bearish outside days. They suggest short-term distribution and they indicate short-term weakness. Now, again, on a day when we've literally made a new all-time high during that session, you can't be too bearish. And that's why I think in this sort of environment, we assume that the trend is innocent. We assume the market is innocent until proven guilty. So what would I need to see to consider this market guilty? Breaking the 21-day EMA, which you're seeing on my chart in green, would certainly be one of those things that would tell me, all right, we're in at least some sort of meaningful pullback. If we would break that 21-day EMA, I think 6,200, which is the low from July, which is a hammer candle that sort of lit up this next bounce higher that we've observed. I think breaking that level would be pretty negative. Other things like spikes in volatility, weaker breadth, weaker momentum are all part of that mosaic that we would think about. But I think from a trend perspective, think about what level, what pattern, what signal we would break that would tell you something's different. For me, that 21-day EMA is currently just below 6,300. That's the level I'd be looking at. I wanted to bring this chart and share it with you just to sort of reinforce the fact that there's a lot of distribution today. The 4 trading days this week are all solid candles. Remember, with candlestick analysis, they're meant to be visual, right? It's meant to paint a picture of market dynamics. So the open candles are up closes, right? We closed at the upper end of this body. We opened at the lower end. So we opened here. we close up at the top. So I always tell people, think of it like a balloon. It's filled with helium. It's floating upwards. So the open candles, we open at the lows of the body and we float up to close at the top. A solid candle, think of it as something solid, like sinking in a pond, like a rock. So we open at the top of the body, we sink down at close at the bottom of the day. And so look at how this week has been very different than previous weeks with all these big white, uptrend kind of days and weeks where we had very few down days along the way. And all of a sudden we're getting this. We're not losing a lot of ground, but we're certainly seeing distribution in the course of the trading day. Now, if that continues, that should be reflected in breadth conditions because stocks are going to be breaking down. Should be indicated in volume conditions because volume's rotating lower. I saw earlier someone mentioned reading my article in the Investopedia newsletter. Yeah, Investopedia is partnered with the CMT Association, which I'm involved with, and they ask for a group of CMTs, me included, to take a week and contribute some, be a guest contributor for the week. This week's my week. So I think you could sign up at investopedia.com. I'm not exactly sure where it is, or I would share the link with you. I should probably know that. But there's an Investopedia kind of chart newsletter in partnership with the CMT Association. And this morning, in this morning's article, we talked about chicken money flow and how some of the volume picture is starting to look a little more negative. Not end of the world bad. And I have that chart to share with you in a moment, but not as good as it was looking about a month ago. Here is the McClellan oscillator. It has been below zero for most of the last 2 weeks. We had one day where we popped above the zero line, but for the rest of the last couple of weeks, it's changed. So the picture has changed from the end of July to now the end of the end of June to the end of July. End of June, the McClellan oscillator very strong because the advanced decline data improving and trending higher. The McClellan oscillator below zero basically means that the short-term breadth picture is changing and rotating to more of a distribution side. It's not really, a long-term signal. That's where things like the cumulative advanced decline lines can be quite helpful. I haven't brought this chart up just because they've been bullish now for a couple months, and there's not much to report except they keep going up. But you're starting to see, potentially a bit of a change here. No divergences. A lot of times at major tops, you'll see divergences where like the, S&P breadth is still trending higher, but you have like lower peaks in mid cap or small cap breadth. You're not getting that here. We're actually having all of these advanced decline lines still trending higher, making higher highs and higher lows here in July. However, we can see that the New York Composite Index, which is that top panel, very, very close to its 50-day moving average. And my general, very unscientific, but very simple to update methodology is if we're above an upward sloping 50-day moving average, it's bullish. If we break down through the 50-day moving average, it's bearish. If we break to a new swing low, that's neutral. If we break to a new swing low, that's bearish. And that's just kind of how I keep this updated. For now, they're all still bullish, but we're kind of getting close. And so the weakness in the McClellan oscillator, speaking to short-term breadth deteriorating a bit, these lines breaking down would suggest more long-term breadth reversals that we should pay attention to. We also like to look at percents of stocks above their key moving averages. Here we're looking at 57% of the S&P 500 members remaining above their 50-day moving average, 58%, almost identical above their 200-day moving average. These things hold 50%. Things are still okay. If they break below 50%, I've learned that's not a good sign. What would normally happen, barring some crazy, I don't know how this would even happen theoretically, but usually what you look for here is the short-term breadth. The stocks above their 50-day would break below 50% first. That'd be a warning sign. The long-term version above their 200-day breaking below 50%, that would be a really negative sign. For now, they're still okay, but again, getting closer and closer to that negative region. We've obviously had down days this week. We've had increasing volume during the sell-off. Today has had some of the largest volume that we've seen in months. As a result, the chicken money flow, and this is what I wrote about in that Investopedia newsletter earlier today. Chicken money flow has been trending downward. So, market making new highs on weaker volume is basically what you're seeing here. That's not good. And what the chicken money flow is actually telling you here is that we're seeing some signs of distribution. The price volume relationship is implying that at least someone with a lot of zeros in their account starting to distribute, starting to sell into that strength. That's not something we saw at the end of June. It's not something we saw even a couple weeks ago. But in the last 2 weeks, we're seeing signs that someone running at least or some cohort of investors are unwinding positions going into this strength. That's what can cause the top for sure. If kind of the smart money, the anecdotal smart money is already starting to sell off. We can see some of this weakness. And as I'm going through these charts, I mean, I'm as a trend follower, I'm telling you the trend is positive, but you know, impressions I'm getting about signs of distribution going into August, they're concerning me a bit here. The Nasdaq 100's bullish percent index is down below 60%, which is obviously well below 70%. So what's happened is from mid-May to now the end of June, that's about a 10-week period. We've gone from 85% of the Nasdaq 100 in a bullish point and figure profile to less than 60%. So what that means is about 25 plus percent of the Nasdaq 100 stocks have had a sell signal on their point and figure chart since mid-May. That might not seem like a big deal, but if you know point and figure methodology, generating a sell signal, it's not just a little blitz. It's not like a one-day thing that does that. It really has to rotate lower. And that's one of the benefits of point and figure charting. It takes quite a bit to move to the next column and generate a sell signal. And this is telling you about a quarter of the Nasdaq 100, which are large cap growth names, which have been doing remarkably well off of the April low, looking less and less good. And this is what is making it feel more and more like Meta and Microsoft, with big earnings wins, with very strong charts, are more and more the exception. And technology and other growth names breaking down after an incredible run is much more the standard reading we're seeing here. And again, that what concerns me is that's what tops can definitely start to look like. The VIX still okay. I mentioned John Kosar earlier today, and we'll hope to have that episode released for you tomorrow. That's on the Market Misbehavior podcast. But we talked about volatility. This was his pick of like the chart to watch. I always like to ask people like the one chart question. What's the one chart you're looking at that you think people should be following? And he said volatility. He was like, look, if the VIX pops, that doesn't happen if everyone's all confident. That would imply, anxiety, fear, and that's what causes a market to go lower. So a great point. I will wholeheartedly agree on that one. VIX above 20 is an important one. By the way, if you listen to my interview with Adam Koch, I thought that was a really good interview. And we didn't talk about this particular chart, but one of Adam's points was, look, I think of big, sell signals like the VIX. I think of them like a tornado siren. It's a very Midwest way of describing things, because that's where you tend to have a lot of tornado sirens and a lot of tornadoes. But he said like a tornado siren, when it goes off, he's like, there's no guarantee. There's no guarantee there's going to be a tornado. And a lot of times there isn't. But when I hear a tornado siren, I'm still going to go in the basement, because that's just the right thing to do. That's the way to make sure that nothing really bad happens, make sure that me and my family are safe. If you ignore when the VIX goes above 20, it's kind of like the tornado siren going off, and you just kind of sit there out on your deck thinking, oh, I bet it'll be okay. It could be. And then you're going to feel like, no, I'm brilliant because I didn't get too defensive. I'm a fan of going in the basement when the tornado siren goes off. So the VIX above 20, while it could just be a tactical pullback, in which case I think the market will recover in enough time for you to probably leg back in and feel okay with it. But I mean, a VIX popping up at 20 is where, big disasters kind of look that way too. And so that's when we want to make sure we get in the basement. I'll let you know if that tornado siren in the form of the VIX spikes. Not quite yet. All right, we'll finish off looking at some charts here, and we'll wrap it up. Here is the chart I mentioned earlier, the equal weighted technology. We often talk about the technology sector. You probably think the XLK, and that's fine. Those sector spider ETFs are very liquid, very, tons of assets invested there. I've used them many times. I'm a huge fan. However, the calculations, given the strength that we've seen in those biggest names, they are very, very top heavy. So in technology, you've got, Microsoft, Apple, and NVIDIA are about half of the XLK, just those three stocks. And so they're very top heavy, meaning they're very concentrated into the top names. So one of the things you can do is look at an equal weighted version. And all of those sector ETFs have equal weighted versions. Most of them, the Invesco versions, start with RSP and then one letter after for the sector. So RSPT is the technology, the equal weighted technology ETF. The XLK does not have a bearish divergence right now, but the equal weighted technology does. Right. So we have higher highs in July on weaker momentum. Small caps, mid caps have this divergence, but the S&P 500, the NASDAQ 100 do not. But I'm noting that equal weighted technology definitely does. In equal weighted sectors, I'm starting to see this pop up. So again, it just reinforces that outside of those magnificent seven stocks, outside of the AI trade, market not looking as strong as I think we want to think it is right about now. Here's Microsoft. I mentioned just a quick update visually. I mean, the trend is positive. We're making new all-time highs today. So let's not deny that. However, the stock was up a lot more. It actually opened above 550, and that ended up being basically the peak for the day. By the close, we ended up near the lows of the day, just above 533. So this isn't like a specific candle pattern or anything that I would highlight for you. But it's not great, right? If investors are super optimistic on Microsoft, we gap higher, and then a bunch more buyers come in because they would be thrilled at owning it going forward. This shows a lot of selling into that gap higher, right? So we gapped higher on earnings, and a bunch of people unloaded Microsoft thinking, great, I can cash in on the stock that just gapped higher. So little concerning. We'll see what happens tomorrow, but let's see if that gap range holds or if it starts to get filled. Meta, a little more constructive. I mean, not great. It ended up being kind of a doji kind of day where the open and close were very, very similar, but we did break above that 740 level. That is. That's a level I would be watching. Anything above there, I think, is still good. But if 740 would fail to hold, that would tell you that breakout is no longer confirmed and we have an issue. All right, here's the chart of Apple. Apple reporting after the close today. We'll check on the post-market trading here in a minute. But in terms of an update from a technical perspective, Apple is really in limbo. It's between two moving averages. It's between two Fibonacci retracement levels. Here's what I mean. On the lower end, we have the 38.2% level, right around 294. That's based off of this big downtrend going into the April low. The 50-day moving average, almost identical, right around 205. So that's kind of your short-term floor, right? Anything above there is okay, but a break below there really suggests a retest of those lows, if not something worse. On the upside, we have the 200-day moving average just above 221. We have the 61.8% level, excuse me, just above 225, holding there. So Apple, very similar to Tesla going into today's earnings report, where I think it's consolidating, it's sideways, and needed to look to say which way we break. Anything above that 200-day, anything above 225, pretty bullish. I was checking this earlier. Yes, we're up about 3% after the close. We're at around 214 right now, which is actually around here. So good that we're gapping higher, but we're still below this resistance around 215, which is actually the 50% retracement. So first things first, we got to get above that level. We'll see if we're able to get above there tomorrow. I haven't gone through their their earnings release in any detail, but I would say for now, it looks like an initial bounce higher, but not enough to really get above just the most recent swing high. We'll see if that changes tomorrow. Amazon also, I mean, just a classic uptrend phase. Apple more consolidating, Tesla consolidating, Amazon in a clear uptrend phase. Higher highs, higher lows. I mean, not much to not like about this chart. I mean, the only issue I would say from a technical perspective is we're bumping up against all-time highs. This is very similar to Meta, kind of bumping up potential big double top pattern. So I think at this point, if you haven't participated yet, you need a real push above 240 to clear that resistance. Aftermarket down. It does not look like a great earnings release for them. Down about 5% to 222, which means we're currently trading around here. So with this one, it looks like the 21-day EMA, which I actually didn't include on this chart, but that's my go-to kind of initial warning. I love having things on the chart that make you not have to think too hard and just say, look, as long as we hold the 21-day EMA, things are fine. If we break it, then I start to revisit it. And that's what allows you to kind of stay confident during these pullbacks to say, yeah, these aren't too bad. But anything that breaks it further, you go, okay, but this might be something a lot worse. It looks like if we kind of open tomorrow, if we kind of close tomorrow below that 226 level, that would break the 21-day EMA for the first time since really the April low. That would be at least a short-term breakdown. So if Amazon ends up rotating lower, really would look like a big double top pattern, which is what Meta has looked like up until today's gap higher. Maybe a similar pattern from Amazon. That's not great, I would say, for one of the Mag 7 names having that sort of miss reflected on the chart today. All right, that is it for the charts that I had prepared. Just want to hit on some of the main ones, and let's continue. With some questions. Darren, I don't know if I've answered one of your questions before, and I appreciate you watching live on YouTube. Thanks so much for tuning in. Hindenburg Omen today. I actually didn't look at this chart. It's far enough down the market misbehavior live chart list, and I sometimes just get distracted. Don't get this far down. That's what happened today. Shall we look at it together? It's I mean, it's not updated, is it? Looks like it is actually updated for today's close, but not all of it though. So some of these things are not updated just yet. I'm actually not sure. This is one that the good people at Stock Charts have this composite indicator, but they run it overnight. So we'll see in the morning if it is. The McClellan oscillator is below zero, which is thing one. Factor two is the rate of change on the New York Composite Index is above zero. That's true. So the question is going to be new highs and lows. You need to have at least 2.5% of the listings making new highs and new lows, which means the green and the red bars need to be over, zero point 0.02 and change. We'll see. Pretty close. And this week it's been very, very close to an initial warning sign. We've had random initial warning signs, but the last completed confirmed signal was at the end of 2024. That's that purple shaded area that you see there. Ended up being what, a month or two before the eventual peak in February, but definitely told me going into this year, start thinking more defensively. And I'm thankful for that kind of signal. It's one of the first big sell signals from indicators that I followed at the end of last year. Not quite enough, it looks like, to have certainly a confirmed signal. Remember, the whole point of the Hindenburg Omen is you have multiple signals within a month, firing, right? So you have an initial warning sign and then a second warning sign that comes a couple weeks later. We'll see if that actually plays out. So to be determined. We'll keep an eye on that for sure and keep you updated. All right, boy. Comments on being a perma bear. I mean, I'll accept a label. I mean, I'm not a huge fan of labeling. I'm a huge fan of. I'll tell you, and I often get that label, and I've kind of come to terms with it. I think and as I've tried to cover, I think for me there are two kind of general things you're trying to do as an investor. Number one, define the trend and follow it. Number two, look for signs that the trend is reversing. The trend has been bullish for a while. Hopefully you've picked up on that every day when I show you, hey, the trend is positive. Hey, this is what's going on. We've talked about our market trend model being bullish for some time. So if you missed that, I don't know what to tell you. We've been trying to reinforce that. But I was trained to always be a contrarian, right? If the market's selling off, look for signs that we're bouncing higher. If this market's rallying, look for signs we might rotate lower. And that means you'll get some false sell signals on the way up. And I think that's okay with that. That's part of the game, is just looking and just thinking about how much risk you want to take on based on whether you see some of those signs. I'm a big fan of looking at tornado sirens and again, just getting defensive. If you think there's a decent chance we could rotate lower. The ugly drummer. I love your name. I love your little icon. I'm a fan. I'm a fan of who you are, not knowing anything besides your name and your picture. So great to take a question from a fellow musician. You said index charts looked like a slinky going down the stairs today. I love that visual. And it's great. I think, and again, if you listen to my interview with Adam Koch, he had so many great metaphors for the market. We didn't talk about the slinky analogy. I'll bring that one up next time, when there's a good moment. Very true. And I think what's helpful about relating the market to something like that, it just gives you a visual about what you're seeing. And then for me, it's not enough to just say, okay, the market's a slinky. It's really thinking about, all right, what is it? What am I seeing that's actually make it play like that? Making it play out like that, right? What would tell you that slinky is going to keep going down the steps? What's telling you there's starting to be accumulation? And again, it does have that feel. I mean, it does have that feel like that first step down when it kind of goes down. And then, as you know, if you've done slinkies, is it starts to pick up. And I think that's the period we're in right now. Do you see elevated volatility? Do you see further deterioration in breadth conditions? Do we see any more meaningful improvement in defensive sectors? That would be kind of a warning sign. We really haven't seen materialize too much. There are plenty of things we can look for in this kind of environment to sort of validate whether a pullback is happening and validate whether a correction is really playing out. I mean, as we wrap the last trading day in July and we wrap today's show, I mean, going into August and September, weaker calendar, right? I mean, weaker time of the year. This is when market pullbacks have often happened. We've often had major lows going into September and October. Between now and then, all I will tell you is I'll be here every trading day trying to see what I'm seeing and try to add incrementally to the picture that we've developed together. I'll certainly be sharing with my market misbehavior premium members changes in our market trend model, changes in positioning, changes in leadership that I think are relevant. And so if that's something you're interested in navigating the next downturn with us, I would encourage you to check it out at marketmisbehavior.com/premium. By the way, people tend to be very interested in improving their game plan during a bear market because then they realize they need it. I will tell you, you probably have been able to get away with a lot of bad habits from April to July. That's what happens during bull markets. All the bad habits don't matter a ton because they don't hurt your portfolio. The next downturn is when all these bad habits start to cause some pain. So if you need some help, look me up at marketmisbehavior.com. Otherwise, have a fantastic evening. Thanks so much for tuning in. Please come back tomorrow. And remember, it's always a good time to own good charts. Have a good night, folks.